This is the fourth quarter update for the Amplify CWP Enhanced Dividend Income ETF, symbol DIVO, and the Amplify International Enhanced Dividend Income ETF, symbol IDVO. Joining me are Kevin Simpson and Tim Seymour. Kevin, let's start with you. What stood out in the fourth quarter?
I think a reemergence and a broadening out of every stock that wasn't part of the big seven. For most of the year, I couldn't wait for the calendar year to end because as a blue chip, high quality dividend growth portfolio, we're not going to participate in most of the high flyers. And when the chairman came out in late October and really pivoted away from a rate hiking environment, which is all we were waiting for. We knew with DIVO that during a period of time when we're going through an interest rate hike off of zero and introducing 550 basis points of yield into the world, all our job really is to just hold the line. Make sure we do the best job we can to protect the assets, which in 2022 made us look like geniuses. In 2023 made us look like non-participants in a 7-stock rally. So the fourth quarter was a rebirth of our portfolio to the extent that we could get back to business. November was a really strong month. December was a really strong month. And instead of waiting for the year or counting down the days for the year to end, I wish there would have been another 2 or 3 months. So we're in an environment again where value, where dividends, aristocrats, DIVO, all of these really high quality companies can now participate once again in what we hope will be a multi-year rising market.
Tim, I'd like to pose the same question to you, but from an international perspective. What stood out to you?
Well, you had dynamics around the world showing some of the same resiliency in terms of economic dynamics. Look at Japan, where their Tankan index is basically their health of the economy, showed pretty interesting industrial growth, but also resilience on the consumer side, dynamics around the banks that continue to support not only balance sheet and credit profiles, but a case where I think if you look around the world as the Fed is maybe pulled back somewhat, it's very, very positive for investing internationally. And so as we continue to see some of the themes in again, it's sector by sector, and it's part of I think the interesting approach that IDVO has to the international investment landscape is you don't have to invest according to index weightings. You don't necessarily have to invest in China. And in a world where some of that data and some of that macro gets worse and worse, stories in Japan, stories across Western Europe, stories in some parts of Latin America for sure have been outperformers again, as the macro around the Fed, the dollar strength, some of the concerns around credit have alleviated. This has made international investing, I think, very exciting.
Kevin, when you look at the DIVO strategy, what changes in the fourth quarter should investors be aware of?
Well, in the fourth quarter, we were able to really see some of the stocks that hadn't moved in 2 years, breathe some life into them. And as we write covered calls, occasionally you'll see a position get called away. And early in the fourth quarter, late mid fourth quarter, we did get our Apple position called away. And this is the 9th time in the past 11, 12 years, whether it's with the SMA or the ETF, that we've sold out of our Apple position in its entirety. And it always gets people a little bit nervous. Like, what do you mean you don't own Apple? Apple was one of our best performers in 2023, so stands to reason that people would have a lot of questions about it. Because of the covered call premiums that we generated on the Apple position, we were effectively out around 187.5. And of course, the stock went on to go to almost 200 immediately thereafter. But as Murphy's Law would have it, who would expect anything less? We rotated that position in large part into Broadcom, which was one of the best performers in November, December, and continues to be that in January. And then just a couple weeks ago, we were able to start entering our Apple position again. So we've been buying it over the past 2 weeks. I realize that's not a fourth quarter commentary, but don't want to leave everyone hanging until March. And the neat thing about that is we were out of the position. It got up to 200. It pulled back about 10%. So we were re-entering it between 182, 183, 184. And then again, the stock moves into what has become a real nice rally again, back up into the 193, 194 range. So that's worked out really well for us. I tend to think it's a little pricey, maybe a little bit ahead of its skis, just looking at the multiples, but we traded it really effectively for DIVO. Certainly the Broadcom that we rotated into did really well. We added to some Cisco. We put a little IBM into the portfolio for the first time in a long time. and they had tremendous earnings that came out today as we're filming this and having this broadcast. Again, not really a fourth quarter success story, but a fourth quarter trade that's translated into a really, really nice move today for sure.
So, Tim, you're a special advisor to the IDVO strategy. When you look back on the fourth quarter, giving your wide lens on that strategy, what changes do you think investors should be aware of?
Well, ultimately, one of the things that markets started to see in the fourth quarter was, and whether this is sustainable or not, these are dynamics that also are very supportive to international investing. It's that broadening of the marketplace, right? It's that equal weighted S&P. It's the economy outside of the Magnificent Seven, and that exists around the world. So what that translated into in 4Q was companies like Sanofi and Novartis and big mega cap pharma companies. Again, as we looked at allocations going into 24, and despite a pretty healthy run for some of the biggest tech companies in the world to start the year, I do think this is the year where you want to have overweights in healthcare, in energy, in utilities, in parts of the broader economy. This is what investing internationally really is I think, hanging its hat on in terms of why it's an exciting time to be investing, because we are seeing this broadening. We are seeing real economy companies that are also benefiting from the efficiencies of not only technology, but even AI. And so some of these names are playing. Some of the sexy pharma names like an Eli Lilly, you have a Novo Nordisk over in Europe. And these are stories that, again, you can pick your spots around the world in a strategy like IDVO. And that's pretty exciting. Companies who are having particular interesting cycle moments in terms of where their core business is and obviously what it translates into payouts and dividend profile.
So, Kevin, we're recording this in January of 2024. Could you speak to some of the covered call positions you have on right now for some investors?
Yeah, we've added some call writing recently. There hasn't been a whole lot of volatility, but we were able to write calls on JP Morgan, both heading into earnings and after earnings. We wrote calls on Cisco, and we've written calls on Microsoft. You usually get a little bit higher vol within the tech space. So we have been able to put positions on and generate a little bit of premium. Heading into the year, we really had very limited call activity in the fourth quarter. And that's really because of the inverse relationship between volatility and a rising market. Of course, 2022 was the exception that proved that rule. But usually what happens when you have lower vol is you have an expanding market. There's an inverse relationship. So because vol was low, we dialed back on the call writing, but we benefited tremendously from total return. DIVO posted a really respectable return last year, especially when you consider what it was up against with respect to the Magnificent Seven. And the greatest thing about periods of underperformance, or at least relative underperformance for value or dividend versus growth, is that after periods like that, history has shown that they tend to go through really nice expansions, because all that's happening is they're growing back into their multiples. Our companies continue to make money. They raise dividends, they buy back shares, but for a year and a half, almost 2 years, no one cared. And now you get to look at these earnings growth in 2024. And I think for the whole broader market, it can't just be better than feared last year. They have to be good. And we're in the heart of earnings season, and I expect that our companies will post good earnings and will be strong beneficiaries of that, both domestically and on the international front.
So, Tim, basically the same question to you for the IDVO strategy, except maybe you could add some flavor on how you approach it philosophically, writing covered calls on the ADRs in the international space.
Well, I think the approach is very similar, and that's why it's a tried and true process, which really is about enhancing already payout levels and dividend yields that are growing in the companies. And so you're looking at, at 3 months, you're not looking to be a hero in terms of where those exercise prices are in terms of out of the money. It's really about consistently adding income, and in most cases, 85% of those calls are going to expire. And they're going to expire having collected that extra income. As we think thematically, though, around the approach to and the research approach and stock picking and some of that, what we believe really is the alpha generation part of the strategy. It's not just generating extra returns for investors. It's about finding the right themes, both sector, top down, and then bottom up, company by company. We really like Japan. We talked about that before, but a Tokyo Mitsubishi Bank, which is the JP Morgan of Japan, which is trading at a price to book of about 0.9. And again, the discount that you often see with some of the international banks to the U.S. peers, and yet payout levels that are growing. capital requirements that might even be more conservative. Dynamics in terms of where you actually have those inflationary forces that are good in Japan for the first time in decades. And people have seen that the Japanese equity market's back at all-time highs. It took 37 years. That's been an overweight in the portfolio for the last year and very much almost even since inception. The energy super cycle, where I would argue that European integrated oils are as attractive or more so than an ExxonMobil or a Chevron here in the U.S., just because the dynamics around their break-evens and around those dividends actually being paid, they break even at levels on oil that are probably 15 to 20% cheaper than even the U.S. integrateds do. We like the trends in terms of capital discipline across a number of these names. And then there's a few, call them, sector-specific special situation types, or, look at uranium. We have a position in CCJ or Cameco, which is one of the largest uranium miners and soon to be in uranium enrichers in the world. This is a global story, just to be clear. And as we all know, whether it is Germany having to kind of reverse field on a nuclear policy that was about to close their last nuclear plant when Russia invaded Ukraine, and Germany's reliance on Russian oil and gas became that much more under the microscope. Uranium is a place that I think, again, global investors are recognizing where you can have those opportunities. I think there's a case to be made for real economy companies. Look at also the auto sector. A name like Toyota, as much as Tesla has been the hot shot over the last 3 years, people are very aware of some of the pressures that are going on with margins. Some of the traditional biggest auto companies in the world, like a Toyota, that have spent a lot of time focused on hybrid and focused on their internal combustion engines, along with an EV future, are names that we think are probably going to be outperforming in the next 12 months. And again, they fit the profile of this strategy, and the strategy endeavors to find those companies that are consistently paying and growing. And the fund management team doesn't really have to reach out the risk curve to find those opportunities.
Gentlemen, let's wrap up with your outlooks for the year. We're recording this in January of 2024. As I mentioned, Kevin, what's your outlook for the rest of the year?
Well, I have cautious optimism, and I certainly didn't have that last year and probably didn't have it the year before, but I like the prospects of the strong economy, the incredibly resilient labor market. It seems like the Fed's going to be making rate cuts before they make rate hikes. I don't know that we'll see the rate cuts as quickly as the whole world is imagining. We may not see quite as many as the world is hoping for, but it doesn't really matter. If you think about it, you look at rate cuts and you say, well, will the stock market be higher or will it be lower at the end of 2024? And I believe because of the strong economy, I don't think we're going to go into a massive recession. I know we have a presidential election that'll create some volatility, but I imagine the markets will be higher because of the Fed policy and interest rates far more than anything else. So I'm looking forward to 2024. The only reason I have any hesitancy in that, or if there's something in the back of my mind that gives me pause, is that I think everyone's feeling the same way. Oh, it's going to be a good year. They're going to cut rates 100 times. Everything's going to be fine. Soft landing, no landing. And usually the herd mentality is wrong. Because last year we all thought, well, they're going to keep raising rates like crazy. Inflation will keep going. We're going to definitely have a recession. And the stock market performed really well. The year before, the Fed dot plot showed 2 rate hikes, maybe possibly 3. Everyone thought it was going to be a really good year. The story from 2021 would continue and the party would go on. And there was instead a major correction in every one of the major indices. So it's just the fact that we've got a herd mentality kind of singing the same song that gives me a little bit of pause. But I think if you look at it with a little guarded enthusiasm, you should be happy when 2024 is over.
Tim, what's your outlook for the rest of the year?
I'm excited for asset allocation to continue to be something that investors have an opportunity to really think about after some of the outsized and concentrated moves in the equity markets in the U.S. Versus around the world versus even other asset classes. Even if we have started the year with some of those themes, maybe even more pronounced than they might have been last year. The reality is that the next 5 to 10 years for investors that are allocating whatever portion, I'll let advisors out there determine what's right for their clients. I'll let investors who are self-directed. The important point is that allocation, especially global allocation, allocation to other sectors outside of technology, broadening of the economy, equal weighted. I mean, these are themes that we're going to continue to see. And that's why investing internationally is fascinating, because there's no question the crowding out effect, especially of passive investing into some of the biggest stocks in the world. I think that leaves opportunities for for names that have been left alone, unloved. And again, certain parts of the world economies that are doing quite well. I think China's probably going to surprise on the upside. And again, I would emphasize, a strategy like IDVO does not need to rely on China doing well. It needs to find the companies that might actually have been overlooked in terms of the profile of free cash flow generation. So that's what excites me. I think investors have real opportunities and asset allocation, which is something that it's all relative to something, right? It's all relative to a benchmark. And that's in a world where we've had a 13, 14-year bull market, and the Dow, I would argue, has been slowly grinding to a close. That opens the world up, and it opens the world up for folks that haven't spent as much time focused internationally. And I think doing that in a strategy like IDVO, that even if the economy gets a little dicey next year, the payout levels, the distribution yields here are things that are part of what goes into the research process.
Gentlemen, thank you both for your time. Viewers, to learn more about DIVO, you can simply go to DIVOetf.com, or to learn about IDVO, go to IDVOetf.com, or visit the Amplify ETF's website at amplifyetfs.com.
It's a big world out there, Jay. Go see it. Go invest in it.